Hi, welcome to Main Street Macro. I'm Neela Richardson. Like most goods, oil prices are determined by demand and supply. But oil has some unique features that set it apart. In today's vlog, we drill down on the price of oil and what it means for Main Street. Let's start with those three key variables. Variable number one is that oil prices are set globally. As economies grow, their energy demand also increases. Natural and man made events can actually disrupt this regular demand for oil. For example, during the lockdown period, oil demand decreased substantially, causing prices to tumble. Oil prices went from over $55 a barrel to under $4 a barrel. Now, when the economy reopened, oil prices quickly rebounded. Last week, recent developments in the Ukraine and Russia pushed oil prices up to over $100 a barrel. That was the highest in over 8 years. Now, in addition to demand, there is a supply dynamic at play as well. Oil production is controlled by just a handful of high oil producing countries. These complicated supply and demand dynamics make oil prices among the most variable and volatile. Now, the second variable that we're looking at is oil prices and financial markets, because financial markets affect oil. It's not just about supply and demand dynamics. Trading and investor sentiment can also affect the price, because companies don't just trade and buy and sell physical oil. They also try to lock in the future price of oil by trading futures contracts and financial contracts based on the future delivery of oil. Now, this trading actually serves a purpose. It helps provide a standard price for the oil market. And like other financial markets, oil contracts are regulated to make sure that there is no excessive speculation. The final place where we see a key feature affecting the oil market is oil prices and the economy. Higher oil prices can trigger rising prices, not just in oil, but in other goods, because oil is a key input in many other goods. And it's also important when it comes to shipping and transporting of those goods. Those activities rely on oil. Now, where consumers see rising oil prices is at the pump in terms of gasoline prices, and even in the grocery store, because energy costs also affect the price of food, and food price increases. What that means is that now that inflation is at a 40-year high, in the short run, rising oil prices could be a big concern. Over the long term, however, higher oil prices actually incentivizes high producing oil countries to amp up that production, which causes prices to fall again. Thank you for watching the Main Street Macro. For more information on the week ahead and the effect of global events on Main Street, please go to adpri.org.